Hello, everybody, and welcome to HardAssetsInvestor.com. I'm Mike Norman, your host. My guest today is Scotty George, making a return appearance. He's the Chief Investment Strategist at Alexander Capital. Scotty, great to see you.
Good to be back, Mike.
Very interested to get your take now. A lot of stuff going on, a lot of stuff in the markets, but a lot of stuff geopolitically. We have the situation in the Ukraine. We have sanctions that have been imposed by the United States and Europe. Looks like another Cold War flaring up, maybe more dangerous than the last one. I don't know. But it's certainly creating a lot of volatility and cross currents in the markets. What's sort of your big picture now of what's going on?
Well, if we could solve that issue in 5 minutes, we'd be heroes. Clearly, the way in which these political events are affecting the markets is to create more uncertainty. And the less certainty there is domestically and overseas, the more the markets are going to continue to roil at the top. And that's exactly what we have. We have foaming, we have upside, downside days. We don't have any consistency in market patterns. And as a quantitative strategist, I'm used to seeing cycles, parabolas that move across the page in an orderly fashion. This reminds me an awful lot in terms of valuation of the way the market looked before the crash in 2000, 1999, the dot-com configuration.
Really? Extended, you think?
Well,
that extreme?
Yeah, let's talk methodology for a minute. I mean, if in fact markets move in cycles, and you can quantify those cycles both for duration and magnitude, we reached the pinnacle of the magnitude of the market's 5-year cycle about a year and a half ago. And what we have now is this combination of froth that I just referred to, as well as a kind of linear expansion of the parabola. So at the top, instead of turning over and nominally creating a recalibration, which would enable us to go up, we're just continuing to go straight up or to the side. Typically, definitionally, what would happen in that type of a configuration is that a linear upswing would be met by a linear downswing. And that's where I think there's danger in the market. There are stocks to be owned in here, but there are really no asset classes nor categories that you can find that are going to maintain an upswing at these valuations.
But, if you look at the S&P's, rally over a 5-year period from 2009, where it effectively doubled.
Yes.
Right. On an annualized basis, in 2000 we had a huge move up, and prior to that.
Right.
But this has been I think this is why a lot of people have not been involved in this move, is because it's been kind of slow and gradual, and it's been the proverbial wall of worry that people talk it can't last, and it's overdone, and the economy is not that strong, and unemployment's still high, and then it seems like every phase there's a new worry. Now it's about the Fed and taper, right?
That's not exactly how I see it. I think that from a configurative standpoint, what you've described is exactly what you would see if you looked at the market on paper. When this new rally began after the credit crunch in 07, 08, we were at valuation levels where the only way to go would be up. There were no downsides left to the market, either in fixed income or in equities. And so I don't think we've climbed a wall of worry. We've climbed a wall of uncertainty. The issue now, though, is that after having climbed that wall, you only know you've climbed it when you look backwards and you see where you've come from. But at these levels here, the issue is how long can corporations sustain pricing against their earnings dissipation? How long can we sustain momentum and consumer confidence in the wake of the kind of crises you're talking about that affects not only the United States, but Europe and our trading partners? I don't want to come on the show and be negative. What I'd like to be is methodological. And from a methodological standpoint, I had a lot more money invested at the crash of 08 than I do now. We're raising cash. We're not committing cash.
Right now.
Correct.
So what would change your view? Suppose we continue to creep higher. I mean, do you just stay in cash until at some point the market corrects,
That's
and that might be much higher.
Well, that's the question that our clients keep asking us. I'll give you a good example. Last year, the S&P went up 30% plus. Our balanced accounts, not those which were fully invested in equity, but our balanced accounts were increasing at about 14%. Now, that represented a market exposure of about 30 to 40% in equities and about 30 to 40% in cash. So the calls that I got at the end of last year were, Scotty, how come the market did so well and we did nominally well?
Right.
And you know what I said? Look back over the 5 years that we've been invested. We didn't experience a crash when the crash occurred because we were smart enough not to be at the top. We were fully invested when the market was rising off of the bottom. And what we perceive now is that as we approach valuation expansion, it's good to take some money off the table. So what do? What do we think is going to happen? I think a hero has to come in. I think we're going to have to see a kind of demographic theme that catches the imagination of the investment marketplace, whether it's in alternative energy, biocare and health and life sciences, even infrastructure redevelopment.
Well, aren't we having the health and life sciences and health care? Isn't that the theme? I mean, you have the Obamacare.
Right.
You have, the whole demographic aging population, the
Correct.
need for more
Correct.
healthcare services. I mean, that's a major theme, isn't it?
It is, but you've got opponents on every side of that issue. And I think the kind of hero that I'm looking for would be analogous, and we're both old enough to remember the space program. If you can galvanize capital towards a mission statement, then what you do is you begin to bring leaders into the equation, coincidentals begin to follow,
Right.
and the laggards begin to pick up. At this point in the market, everything is a leader, everything is expensive, and there really are no hero focuses, no hero sectors that can pull this market up.
Not everything's expensive, and I'll segue into the commodity area,
Yes.
which is what we like to talk about. I
Right.
mean, that's been very depressed.
It
Why
has.
wouldn't you be looking at that now as a counter-cyclical play, as a contrarian play?
I'm so glad you brought that up because the question then would be, if you're following the logic of our discussion, you have to be invested. So where would you be invested? What are those counter-cyclical sectors in which to invest? And clearly tangible assets and the potential for price pressure and inflation in those assets, which already exists in agriculture, milk, beef, corn, grain, that's where the pricing pressure is. So clearly tangible assets is one of the sectors in which we favor right now.
And they're not the hot sectors anymore.
But that's the problem. You see, everyone is looking.
No, I'm saying that's a good thing.
Well, it's a good thing for
that's the way I think,
investors.
anyway.
It's a bad thing from a methodology standpoint because everyone is focusing at the apex and wondering, what do we do here at the peak? Where do we go? Well, you've got to revert back to those counter-cyclical sectors that have not yet pushed up in the market. And that would be an example of some of those heroics that we're looking for.
Let me ask you something. Let me ask you about gold. And the reason I'm asking you is because I went back and watched one of your appearances in 2011,
Correct.
2011,
Right.
when you said it was overvalued. That was an amazingly correct call.
Correct.
What is your view now on gold?
Well, I think gold is not yet ready to take off. There's nibbling in precious metals, in the silvers, the coppers, and the golds. I don't think it's quite ready to go, but that gives us an accumulation period in which we could probably put some money to work for future use. Your question and the fact that you brought up one of those previous interviews really highlights the nature of what it is I do for a living for my clients. There's the analysis part, which is pure empirical data, but there's the application of that. There's having the guts to be able to
Right.
go out and put that money to work. And that highlights the notion, Mike, that money is always traversing cycles, that you're either in an up cycle on the left side of the parabola, you're in a down cycle on the right,
Or you're going sideways.
or you're going sideways, and therefore you've got to know how to rebalance risk.
Right.
So if gold was expensive at its apex 2 or 3 or 4 years ago and now having come down, that makes it an opportunity
Yeah.
now. So you've always got to be aware of the fluidity and the nature of cycles and to know where you are.
Yeah, I agree. A little bit like surfing. Always great to have you, Scotty.
Thanks, Mike. Pleasure to be here.
That's it for now, folks. This is Mike Norman saying see you next time. Bye-bye.